Good evening and welcome to the second session in our spring term money webinar series by the Institute of International Monetary Research in collaboration with the Vinson Center for the Public Understanding of Economics and Entrepreneurship at the University of Buckingham. I am Damian Pudner, Director of the IIMR, and today we are delighted to be hosting Geoffrey Wood. Geoffrey is Professor Emeritus of Economics at the University of Buckingham and has lectured in economics at the University of Warwick and in banking and finance at City University, where he was professor since 1986. He worked at the Bank of England as an economist and later as special advisor on financial stability from 1994 to 2004, and is also a former special advisor to the Treasury Select Committee of the House of Commons. During his career, Geoffrey has advised several overseas central banks and national treasuries and continues to advise a number of financial institutions today. He was also visiting scholar at the Federal Bank of St. Louis. He is the author, co-author, or editor of over 30 books and has published over 100 papers in a number of academic journals. His area of research extends to monetary economics, monetary history, and financial regulation. I should also say that we are very fortunate at the Institute to have Geoffrey as a member of our Academic Advisory Council. Today, we will discuss financial stability and what causes banking crises. So Geoffrey, thank you for being with us today. Financial stability and the role played by national central banks is a very topical subject at the moment, given the failures of several US banks and of course, the forced marriage of Credit Suisse by UBS. I guess a good starting point would be to explain to people, what is the definition of a financial crisis?
Well, that's a very good starting point indeed, Damian, because it's something that many people, including central bankers, and I should perhaps say particularly central bankers, get wrong nowadays. And to answer it clearly and correctly, I think we need to consider what the financial system is for. When we're interested in finance, we're interested in the economy as a whole, what it does for borrowers and lenders across the country as a whole and perhaps overseas. But if we're thinking about a national currency, then we're thinking within borders of that nation state, except of course for the odd example of the euro, which happens to be a currency with no nation state, but several nation states purportedly. And I note the word purportedly, when we come back to it, purportedly responsible for it. So then we are concerned with the set of financial institutions and markets that serve the interests of people at large in this country, not in other words with any one institution. And that brings me really, I think, to the heart of the whole argument. So long as the system remains sound, so long as it remains functioning reasonably smoothly, but not too sudden changes in the cost of transacting, then we have financial stability. If an individual institution fails, so long as this does not cause problems for the system as a whole, that is not an example of financial instability. I think, a good example is the grocery industry. Let me suppose there are 3 large chains of groceries with branches near me. Suppose one of these branches and one of these firms failed, what would happen? Would there be an immediate panic that the grocery system was about to collapse? No. Rather, there'd be immediate excitement in the firms which had not collapsed, thinking how they could take advantage of this, how they could rush in and take over the business. Why is it different in finance? The difference, I think, lies in the nature of banking in particular. Banks nowadays are, and have been for well over 200 years, what are called fractional reserve banks. And that's why I think we worry particularly about them. What does it mean to be a fractional reserve bank? Well, suppose that Damian brings his money into Wood's Bank and deposits it, however unwise that may be, with Wood's Bank. What does Wood do with it? He may put it under the bank in a vault, in which case it's what's called a cloakroom bank. I simply look after his money for him, charge him for so doing, and let him have it back when he wants it. But in general, that's not what banks do. They lend out most of the money that's been deposited with them. They lend it out, charge for lending, so that they can cover their own costs and also pay Damian a bit because we've got his money. He's provided us with our input, cash, and we're lending out most of it. Notice we don't lend out all of it. And we also have to have some funds of our own, which is known as bank capital. Why don't we lend out all the money that Damian has deposited with us? Well, the reason we don't lend it all out is that while we expect on average, day by day, that deposits equal withdrawals in my bank, this does not need to hold on every day. So we need to be prepared for outflows, occasionally exceeding inflows. Suppose we lend money to, let us call it Castañeda's bank. As you may know, there is a Juan Castañeda associated with the banking sector. Suppose we lend some money to not Castañeda's bank, Castañeda's wine production, and his firm goes broke and he can't pay us back. We need to have some capital of our own, some money of our own, so that we can repay our depositor, Damian, even though our customer or borrower, Juan, hasn't paid us back. So banks need capital, some money of their own, and they need liquidity to pay out deposits if necessary. Therefore, the banks are exposed in two directions. They're exposed through loss of capital, and they're exposed through loss of liquidity. Now, I should, for the most part, like to set loss of capital aside, because that causes problems for banks only very, very slowly. There's a saying in banking that loss of capital kills you slowly, loss of liquidity kills you very quickly indeed. To indicate how, and this is a subject I should come back to when we discuss Credit Suisse, but to illustrate how slowly loss of capital kills you. Many of you will be familiar with a British bank, no longer exists. It's called Midland Bank. If any of you travel to the centre of the financial district in London, centre of the city, and stand in this triangle of streets, you will have on your right-hand side the Bank of England. If you look to your left, balancing the Bank of England, so to say, is a magnificent building. It was completed in 1934. That was then the world headquarters of Midland Bank. In the year that building was completed, Midland Bank was the biggest bank in the world, 1934. It has declined on average every year since then. At one point, receiving ignominy of a takeover bid from its advertising agency. And it eventually was swept up into the arms of what is now HSBC. The bank has vanished. That was a firm that, through a series of bad decisions over lending and takeovers, it gradually got smaller and smaller until it was taken over itself. On the other hand, loss of liquidity can wipe you out almost instantaneously. A current topical example is Silicon Valley Bank. Funds drained out from that very rapidly. The bank got into difficulties and it needed assistance. Whether it received assistance in the right form, the sensible form or not, is for later in my remarks. So far then, fractional reserve banking systems exist to assist the economy, but they are inherently fragile by the nature of fractional reserve banking. They're exposed to capital shocks and liquidity shocks. Capital shocks I've explained. What is a liquidity shock? A liquidity shock is when there is a sudden demand for cash from this bank. Why might there be a sudden demand for cash? Could be driven by a rumour, that's possible. But a much more common cause is if depositors at this bank see another bank getting into difficulties and they think to themselves, I thought that bank was perfectly sound. How do I know my own one is sound? I rush to take my money out. But we need to think carefully at this point, what does taking your money out actually mean? There's been talk of runs over the internet. A run over the internet has to go somewhere. It has to go to another bank, or as it so happens in the United States, to bodies called money market mutual funds. There's an institutional peculiarity, and I wish to forget about them for most of our talk, but it's an important peculiarity, and I'll come back to it. If the funds run to another bank, then all that's happened is that one bank has contracted and another bank has expanded. There has been no threat to the stability of the system as a whole. Might we somehow want to assist a bank which has lost liquidity? Well, we might. It might have good securities to offer. And if it offers good securities against which we can borrow, we would happily lend to it. We, and I haven't yet defined who we are, might lend to it any security simply because the money was secured on the asset, underlying asset, not on the bank itself. And therefore, this bank could get some of its liquidity back. So far, I've covered, I think, what financial stability is. It refers to the stability of the entire financial system. It does not refer to the stability of an individual bank, however big. However big is very important, and I shall underline it because I'll come in a few moments to the failure of what was at the time the biggest bank that ever existed. Now, if we see a liquidity failure, what is to be done about it? People knew about that for a very long time ago. And the problem was solved by practical men dealing with a particular problem. One Francis Baring of Baring's bank family, writing in 1797 of a crisis, a genuine crisis that broke out in 1793. This crisis was the sudden outbreak of war with France. I put it that way because it remains unclear even to this day who declared war on whom. Indeed, if anyone declared war on anybody, but war broke out between England and France in 1793. And it broke out very suddenly. Let me quote from Baring. That dreadful calamity is usually preceded by some indication which enables the commercial and moneyed men to make preparation. On this occasion, the short notice rendered the least degree of general preparation impossible. The foreign market was either shut or rendered difficult of access. The merchant would not purchase from manufacturers. The manufacturers in their distress applied to the bankers for relief to cover their running costs. As the want of money became general, that increased generally by a general alarm. The country banks in Britain in those days were banks in the country which didn't do any banking in London. They were tended to be the smaller banks. The country banks had recourse, first of all, on the London banks, and the cash was drained from them. And as Baring put it, that resource finally terminated in the Bank of England. In such cases, the bank had not an intermediary body. There is no resource on the refusal, for they are the dernier resort. He broke into French. Why did he break into French? Because one of the many institutional peculiarities in this story, when he was a schoolboy, he went to the French school in Pudner. The dernier resort was the formal name for the final court of appeal in France at that time. So he was saying, in effect, the Bank of England was the final court of appeal for bankers. Why so? Because Britain was on the gold standard, but probably nobody except the Bank of England knew how much gold they had, so the Bank of England could issue notes sufficient to meet the demand. Now that one was actually done, and it stabilized the system. This was elaborated into a theory, notably by the great Henry Thornton, popularized, I guess, by Walter Blanchard. Thornton put it, if any bank fails, a general run-up on the neighboring banks is apt to take place, which had not checked in the beginning by a pouring into the circulation of a large quantity of gold leads to very extensive mischief. And who is to pour in this gold? Thornton answered that question too. If the Bank of England in future seasons of a loan should be disposed to extend its discounts, in other words, lend more freely than heretofore, then the threatened calamity may be averted. Now let's think how that actually works. You go to your bank, you demand payment of your funds. The bank is short of them, but it immediately scampers to the Bank of England or telephones the Bank of England. In those days, it walked to the Bank of England, got money from there, and you were perfectly happy with Bank of England notes. So the system was stabilized because the panic ended. Thornton himself has in fact applied this very interestingly when he was a partner in a bank. The bank subsequently, after he left, it failed, but he behaved most ingeniously. There was a run on Thornton's bank. The idea got about that it was in difficulties. The bank, as it so happens, was in Birchin Lane. Birchin Lane in the city is just across the road from the Bank of England. Well, there was a run on Thornton's bank. What was to be done? Thornton was known as a skilled, honest, careful banker, a man of very high reputation. He rapidly consulted the biggest customer. And what did he do? He asked him not to deposit funds, but to withdraw a very large amount of funds. He came, he withdrew his funds, was given them immediately, and then, displaying sound good sense, ran around to the back of the bank and redeposited them. Confidence was restored by people seeing that the bank could still be out and the panic was over. What is essential in a liquidity crisis is to restore confidence. You should not, of course, restore confidence to unsound institutions. What you should do is lend to institutions on securities which are generally acceptable. And if the institution runs out of sound securities, then, as the saying goes, when they go to the governor of the Bank of England for further help, the governor of the Bank of England says, Thank you for coming to see me. I look forward to meeting your successor. So the plan is then that liquidity should be provided so long as an institution has good security to offer. Notice how this polices the system. It ensures that banks are holding adequate by the standards of what they've experienced amounts of liquidity. This ensures that pouring the liquidity in this way stabilizes the system if there is a banking crisis. The most striking bank fail was the Ovren, Gurney and Company. It was the form of the merger of two banks. Two banks had both been very cautious. They merged. The younger generation took over the running of the bank. And younger generations, as I'm sure you know, perhaps got a little overexcited sometimes. So they expanded too fast, took on too many risks. There was then a downturn in the economy. These things happened. And this downturn in the economy, lots of loans went bad. They went to the Bank of England. They rapidly ran out of liquidity. And in consequence, the bank failed. The fact that this bank failed caused immediately a great panic in London. The panic lasted perhaps slightly longer than was necessary, because for once the Bank of England actually hesitated in providing liquidity. But the moment it started to provide it, the panic was over. Everyone knew all the other banks were going to be okay. And crises subsequent to this one, the Ovren and Gurney crisis, were essentially nipped in the bud by the feeling, the belief, borne out by practice, that the Bank of England would act properly. So the consequence of this is that the Bank of Britain has experienced no banking crisis at all until, I suppose, the global banking crisis. Between then, through world wars, through First and Second World Wars, very Great Depression, there were no banking crises in Britain. One could reasonably say, when one looks at individual banks for a moment, take any year you like, any year at all. More banks failed in that year in the United States than failed in the United Kingdom in the preceding 100 years. You can say that any year you like. The system was remarkably stable. A lender of last resort was not the only explanation for that, but it is the crucial and most important explanation. We might talk of regulation, but it's also worth bearing in mind there was no banking regulation at all in Britain until 1979. And indeed, in the 19th century, banking regulation was progressively relaxed as the system became more stable. Banks learned to live with the system and it was stable. That describes a world less exciting, I should say, much less exciting than we have nowadays. What has gone wrong? Well, various things have gone wrong. But it seems to me that a good part of what has gone wrong is banking regulation. How might that be? Our starting point here again is to cast our memories back. If we think a little, we can think of the names of many banks in Britain. There was Midland Bank, I've mentioned that. There was the Bank of Scotland, there was the Royal Bank of Scotland. There was the British Linen Bank. There was the Bank of London and Manchester. There were numerous banks, and the names all signified one of two things. They signify, there was Lloyd's, was Bank of London in South America. The names signaled either where they operated, which part of the country they were based in, or occasionally, like the British Linen Bank, they designated the main trade with which they dealt. And all these banks were different. And this means, of course, that when a shock came along, all these banks, a genuine unexpected event, all these banks were affected a little bit differently. They didn't all fall together because they weren't all the same. The banks were heterogeneous. And that is immensely important. That's the first harm regulation has done. Regulators can't help thinking, what is best practice? What's the best way to run a bank? What should it hold? They suggest this, and I suppose a courageous banker could say, I know better than you, or I know differently. But the point is not whether what they say is better or not. The point is that they be different, making all banks the same or very similar, as regulation tends to do, makes them all exposed to common shocks. Which is why, of course, as people looked across the United States, when the Silicon Valley Bank failed, people thought to themselves, maybe our banks like that. All banks are now quite alike. Some minor runs started in other parts of the country. Happily, they were soon nipped in the bud, or just died out. Similarly, in continental Europe, there was a flutter of panic when Credit Suisse was absorbed into the perhaps not entirely willing arms of UBS. That I think was a special case because Credit Suisse this year was like the Midland Bank some years ago. Everyone knew it was in decline and struggling and was cutting corners and desperate to make profits. But it seemed to be hanging on, and suddenly something went wrong. And need to be bailed out. Indeed, if you see a bank struggling desperately for profits, suddenly making a new move, moving into a new market, that is a bad sign. Barings Bank has the distinction of being the only British bank that has failed twice under its own name. The first time it failed, it was taking on high-risk activities in Latin America. Some of the things it was lending on were, I think, thoroughly credit-worthy. Its loans are paid for the development of the sewers in Argentina, which are still in use today. They paid for the development of the Teatro Colón, the Argentinian opera house, the first one in South America, still in use today. But nonetheless, things are wrong in Argentina. There was some trouble with the government. The government threatened to default on its debts. This led the Central Bank of Argentina threatening to default on its debts, and Barings was in some difficulties. But why did it go here in the first place? Because it was being driven out of its local markets by new thrusting competitors. It was doing badly at home, so it took on high risks overseas. This incidentally sends very much the same story, simply in a different part of the world as brought Barings down the second time. In the 19th century, it was brought down by failure in Latin America. In the 20th century, it was brought down by problems in the Far East. And in both cases, they had been desperately trying to make money because they were not doing terribly well at home. So then, lender of last resort can contain these difficulties. You look as if you were about to ask a question, Damian.
I was going to ask a question. I was just going to ask two questions, actually. I mean, you say that there were very few banking crises in the UK over the last 100+ years. I mean, can you maybe explain to people the difference between what Anna Schwartz in 1969 called a real crisis and a pseudo crisis? So the difference between a banking crisis and a financial crisis.
Banking crisis is when the actual heart of the banking system is threatened. There's a sudden, threatens to be a sudden fall in the stock of money, a sudden collapse in bank lending. What might be a financial crisis? We'll talk about these all the time, with sharp falls in the stock market, perhaps sharp rises in interest rates. For example, when the Truss government announced expenditure cuts, and in a sense, it was like that joke of Dudley Moore's. He had all the right notes in his Mozart concerto, but the wrong order. The Truss administration was the same. They announced the expenditure cuts, and of course, excellent thing to do if you can cut taxes, but they didn't cut expenditure in advance. They were going to cut taxes, get the revenue, balance them with revenue by cutting expenditure. But they didn't announce the expenditure cuts. And again, because of, I would suggest, grotesque failures on the part of the banking regulators. There was severe insurance regulators, the same body essentially. There were immediate difficulties in the government securities market. Panic. Bank of England, as seems often to be the case, was entirely hapless, flung its hand in the air, hadn't a clue what was going on. The panic meant that the government had to change. The expenditure cuts, the tax cuts were reversed, and so on and so forth. But there was considerable, very considerable ineptness on the part of the Bank of England and the regulators, and clumsiness, perhaps over-exuberance of young people on the part of the Truss administration. So again, that was a financial crisis, but it wasn't a banking crisis. No one said, my goodness me, Barclays Bank is failing. My goodness me, NatWest is failing, because they weren't. There was no threat at all to the banking system as a whole. One set of institutions can fail, there can be a sharp collapse in the stock market, but that's not a banking crisis. People, I think, do confuse the idea. You mentioned Anna Schwartz, very important in this context. They do confuse the idea because of what happened in the United States in 1929 to 32. There was a major collapse in the stock market, but at the same time, there were a wave of bank failures. And for some reason, the Federal Reserve, the US central bank, failed to provide sufficient liquidity. There was a surge in the demand for liquidity. Individuals wanted cash. Banks wanted to build up their cash holdings so that they were safe. The Fed didn't provide enough of it. Why didn't they? There are various explanations why they might have done it. Possibly they're all true to some extent, but the basic point is that not enough liquidity was provided. This meant that a crash on the stock market, because people would then scramble for cash, turned into a crash in the banking system, or rather a major and rapid crumbling in the banking system. There was a major fall in the stock of money, and the US economy fell very precipitously. It turns out it was the deepest and longest lasting recession in US history. It lasted from 1929, or if you look at when US national income got back to its 1929 level, it was 1942. If you think of income per head, it was after that, but I don't exactly know when. A very deep and very long-lasting recession, because the financial crisis was allowed, by one reason or another, to turn into a banking crisis. Financial crises can be troublesome. They have to be sat through, but they don't wipe out economies. Banking crises do. If, for example, again, consider your pension scheme, David. University's pension scheme is very solid, but its value fluctuates because stock market investments fluctuate. You know that on average, you will be all right. Everyone knows on average they'll be all right, so they don't really worry. This is the average fluctuation just cancel out over the lifetime. That's entirely different from a banking crisis, where you do worry very much about what happens to it in an individual episode. And it's the banking crisis, distinct from the financial crisis, that are important.
Excellent. Okay, so with the distinction between the two types of crisis, the banking and financial, and the two types of cause, the capital and liquidity, I mean, can we look at the crisis of 2007-9, and was the budget doctrine followed then, and was it the correct thing to do?
That actually is a very difficult question, because remember, the crisis affected a large part of the world, and therefore may have been different in different countries, and indeed different in different banks. A very nice example in Britain, let me deal with this example, was Northern Rock. It was a building society, a mutual institution, which lent to its depositors so that they could buy houses. These building societies were long-standing and pretty stable, even though the sum was very small, but they were pretty stable. As written, people tended to repay the loans. I say tended, almost everyone repaid the loans. And if they didn't, the loan was secure on the property. So most of the money went back to the building society and its depositors. But Northern Rock took advantage of the permission to change from being a building society to demutualize. It became a bank and became quite adventurous in property lending. But the first thing it did wrong was to be a bank stuck to property lending. And that could be fine. There could be no problem there at all. But in addition, thought it would be very sensible to save costs, but it is sensible to save costs. But they didn't get all the money from depositors. They had to go to the wholesale money markets, fine. But it was cheaper to go to the wholesale money markets relatively infrequently. They didn't undergo the transactions costs of going, say, once a week or even once a day. They went once a month and perhaps even less frequently towards the end. This saved them money on average, but it exposed them to spikes in interest rates. And in fact, they went to borrow when there was a big spike in interest rates, and they got into difficulties simply because the borrowing costs suddenly soared. At the same time, almost got out of Northern Rock because of some still difficulties, and people tried to get the cash out of Northern Rock. Many depositors in Northern Rock were small retail. And what perhaps made things worst of all, that Northern Rock's main London branch was within, I guess, less than 100 yards of the Bank of England. So film crews could film queues of depositors trying to get their money out. What is better designed to trigger a bank run than seeing a queue of depositors outside a bank waiting for the money? That was the problem, this run on Northern Bank. Now, and the Northern Bank was eventually taken over and then sold off to Virgin Money, as it happens. And when this is examined, we find that in due course, Virgin Money actually made money out of the deal. Because, of course, they were buying a portfolio of largely residential properties, which unwound, unliquidated, were still paying off their interest rates. Customers still paid them, paid the bills, and so on and so forth. So the portfolio was actually sound but illiquid. Why didn't the Bank of England act very rapidly to meet this demand for liquidity? One might fling one's hands up in the air and say, who knows what they were doing? But another explanation might be that they just hadn't met such a problem for a long time. Financial stability had been something that had always been there and eliminated everybody in the bank. No one that had any experience at all was sudden panic like this, and therefore tended to concentrate on the more perhaps fancy and sophisticated things of model building concerned with running macroeconomic and monetary policy. The business of financial stability, most of the time, is very unexciting. The problem is that when it becomes exciting, perhaps it becomes too exciting. Again, to quote Oscar Wilde, it's a bit like in the importance of being earnest. A young lady, Gwendolyn, if I remember correctly, is told to read the book on Indian currency and finance, but to omit the chapter on the fall of the rupee. It is somewhat too sensational. Bank failures are very sensational and happen very unusually and very exciting, and I think they do disconcert people, including the people who are trying to manage them. So I think it was institutional failure, lack of experience, all sorts of factors that one could point to. In any event, I do think the bank got it wrong, but that's neither here nor there. The past is the past.
I guess that brings us nicely on to the next question, really. Is there's a belief that some institutions are too big to fail. Do you think there's a need to remove the implicit guarantee that too big to fail institutions enjoy? And therefore, should some banks or firms' banks be allowed to fail?
Well, yes and yes. Alvin and Garnier Company failed in the 1860s. Was the biggest bank that ever existed. It failed. The biggest bank in the world that failed. Why shouldn't it happen again? Banks should have this implicit guarantee removed. The late Eddie George, when governor of the Bank of England, remarked in private, and I think reasonably publicly, that he was very glad that Barings had failed, because it was big enough for everyone to notice, but not so big as to matter. And he thought this would remind people that banks could fail. Or maybe it did, who can tell? Because banks eventually came to regard themselves as invulnerable, and I think they were partly treated that way by governments as well. They were very important institutions. They were national champions, and if you see any company being called a national champion, that's the time to take for the hills, really, because we know that governments will do foolish things to protect them. So banks should not have an implicit guarantee. And that is a very important part of preserving stability in banking. One of the problems with regulation is that it tries to make banks safe. Big banks are safe, regulators think. We impose lots of regulations on them, and we impose them on all banks. This makes it very hard for new banks to enter the system, because small banks have to conform. The same regulations, have the same management structures, risk officers, and so forth as enormous banks. So the costs of entry are very, very high. And if the costs of entry into the market are high, then of course it is very difficult for exit to take place. Because if there can't be easy exit, it can't be easy entry, I didn't put it this way, there can't be easy entry, then the dangers of having easy exit are great, simply because if one firm leaves and nobody else comes in, who's going to take the place? It's always going to be that difficult to some extent. Because if a firm leaves, there's a certain amount of institutional knowledge. Well, the institutional knowledge isn't in the buildings, it's in the people. And the people will by and large find jobs elsewhere. But that takes a little time. So there is need for, in a sense, a steady turnover of individuals, a steady turnover of institutions in the banking sector, as there is in every other sector. Because if it doesn't happen, the incumbents become sleepy, become greedy, certainly lazy, take foolish risks. They think we're invulnerable, we know everything. Anyone who thinks that bankers don't behave that way might care to read about the failure of the Royal Bank of Scotland. That was somewhat exciting.
So I take it that you're against additional bank regulation then, given what's happened in the US. I have
seen no example of bank regulation actually helping. That's the point, really. Bank regulation presumes that we know what all the dangers are. We don't. Many years ago, a distinction was made between risk and uncertainty. Bank regulators talk a great deal about risk. They tend to avoid uncertainty because they know they can't do anything about it. A risky situation is if I invite you to take a bet, purest situation, invite you to take a bet on the toss of a coin, heads or tails, 50% out of the way. You didn't know the outcome of the risk. If you put your money on heads and it comes up tails, you lose your money. That's the risk. Uncertainty, you don't know the range of outcomes. You don't know how likely each outcome is in this range. You don't know all the possibilities. You don't know how likely any of them are. You just know that you cannot be sure. Therefore, you diversify your portfolio. You have different kinds of banks. Uncertainty is really what we should worry about in regulation. And uncertainty should encourage regulators to almost compel, except you can't do this, to compel firms to be heterogeneous. Say to firms, you think this is a good bank? Very well, you can't have it. Somebody has it already. What you should do is simply stand back, and let firms choose the kind of model that they think suits their business best. If we look at banking, right up to the 1950s, maybe even the 60s, we'd observe that's how banks behaved. They had different amounts of capital on the balance sheet relative to the size of the balance sheet. They held different liquidity ratios. They held their capital in different forms. They held the liquidity. Some of it was always in deposits at the Bank of England. Some of it was always in British government treasury bills because they were almost instantaneously negotiable. But they had all sorts of other short-dated paper. And of course, also, they were very careful about who they lent to. And indeed, very importantly, who they took money from, who they borrowed from. In other words, they knew their customers, thus protecting themselves against risk. Now, again, knowing your customers may seem perhaps unnecessary if you just have money, you've got security and so forth. Now, it's a very large bank, Bank of Credit and Commerce International. It originated in Pakistan, but it was eventually headquartered itself in Luxembourg. It had a very big branch in London, very big, a few branches throughout the country. This bank was suddenly closed by the regulators on a variety of grounds. It was behaving fraudulently, perhaps illegally, numerous grounds. It was closed suddenly. It was agreed within the Bank of England that this was necessary. This bank was very troublesome, possibly dangerous. But the bank also feared that because this was a big institution, other firms in the city might have lost money to it, and they would therefore get into difficulties. Now, in those days, there was a set of firms in London called discount houses. What these were in was mainly in the business of taking deposits from banks and lending them to other banks. They traded on very fine margins, had small amounts of capital, and they survived for as long as they did, some institutional historical factors, and also because they had access very quickly to the Bank of England for liquidity. Well, when BCCI was suddenly closed, the Bank of England was frightened that the discount market would, the discount houses would be in difficulties. So it consulted them. None of them had taken any money from or lent any money to BCCI, simply because BCCI did not disclose enough about its own business to be trusted. So in other words, you do take seriously knowing your customer. Some things they did know about the customer. BCCI had an exceedingly lavish head office, enormous offices, polished furniture, great views and so forth. And a new entrant to banking in an expensive city, that did rouse concerns. So people just didn't, the financial sector by and large did not deal with. There should be no systemically important institutions. It's an essential point. It should always be possible to wind up banks in an orderly fashion. The FDIC, the Federal Deposit Insurance Corporation in the United States, very often does an excellent job. Maybe even nobody even notices. The bank closes on Friday as usual. It reopens on Monday. Maybe nobody notices that it's been taken over by the FDIC in the meanwhile, and then sold off or run down. Now, I agree it's hard to do that with a big bank, but that's what we should be aiming at. That's why, for example, in the Banking Commission in Britain, urged banks to draw up what they call living wills, to essentially instruct people what to do if the bank got into difficulties and had to be taken over. The living wills, so to speak, told you where the bodies were buried.
Okay, so that goes back, of course, you say, to the orderly unwind or preparation and, yes, a system of orderly unwind for banks that should be put in place. Okay.
To use my opening example, one of Britain's large food supermarkets suddenly got into difficulties and went broke. Nobody would say, oh dear, what are we going to do? How are we going to deal with this? They would immediately go to the bankruptcy courts. They'd be taken over. They'd be sold off. I imagine they'd be very eager auctions for most of them.
Excellent. Okay, and with that then, Geoffrey, thank you very much for your time as always, and I'll speak to you soon. And everyone else, thank you and good night.
It's been a pleasure. Good night.